November 1963 was supposed to destroy American Express forever, a subsidiary guaranteed loans backed by 1.8 billion pounds of salad oil that didn't exist. Tanks inspected and certified were filled with seawater with just a thin layer of oil floating on top. The fraud was massive. American Express faced liabilities of $210 million when their entire shareholder equity was only $78 million. The stock crashed from $65 to $35 in weeks, dropping 43%. Every institutional investor panicked and sold. American Express was organized as a joint stock company with unlimited liability, meaning shareholders could be personally liable beyond their investment. Trust departments dumped the stock, terrified of catastrophic losses. Wall Street declared American Express finished. American. But one 33-year-old investor from Omaha saw something nobody else did. Warren Buffett recognized the difference between temporary crisis and permanent impairment. He bought 5% of the company for $13 million when everyone thought he was insane. That investment eventually turned into over $1 billion, making it one of the greatest crisis investments in history. Let me show you the exact strategy Buffett used so you can apply it to the next panic. The salad oil scandal started with a con man named Tino De Angelis who ran Allied Crude vegetable oil. He leased old petroleum tanks in Bayonne, New Jersey, and filled them with seawater, then added just enough salad oil on top to fool inspectors. Since oil floats, inspectors checking the tanks saw oil and assumed the tanks were full. De Angelis used fake warehouse receipts from American Express warehousing subsidiary to borrow hundreds of millions from banks. He then gambled all that money on vegetable oil futures, betting Russia's crop failures would spike prices, but Russia had bumper crops instead. Oil prices crashed. De Angelis couldn't meet margin calls. When investigators finally demanded to see the actual inventory the scam unraveled, Allied filed bankruptcy November 1963, owing over $200 million backed by oil that didn't exist. American Express was on the hook as the guarantor of those warehouse receipts. Leave a comment below telling us where you're from and whether you've ever invested during a crisis. Also hit that subscribe button because what I am about to reveal about Buffett's investigation process will show you exactly how to evaluate companies during panic. Let me walk you through his methodology step by step. The market's immediate reaction was terror. American Express stock collapsed. Everyone assumed the company would go bankrupt, but Buffett asked the only question that mattered. Does this scandal destroy the core business permanently or just temporarily damage the stock price? American Express had three main businesses: Traveler's Checks with 66% market share, the new American Express credit card launched in '58 that just became profitable in '62, and various money processing services. The warehousing subsidiary that caused the scandal was tiny, $12 million in capital out of a massive financial empire. Buffett's key insight was recognizing that American Express's real asset wasn't physical inventory or warehouse receipts. It was trust and reputation in financial services. So Buffett did something brilliant. He hired investigators to do what he called scuttlebutt research. His team interviewed bank tellers, bank officers, restaurant owners, hotel managers, credit card holders. They produced a foot-high stack of reports. Every single interview said the same thing. It was business as usual. Traveler's Check sales grew 28% in December '63 compared to the prior year. Credit card billings rose 44%. Customers didn't care about the salad oil scandal. They cared whether American Express honored their checks and cards. And American Express kept honoring everything perfectly. The core franchise was completely intact. Only the stock price was destroyed. Buffett's second crucial decision was urging American Express management to settle all claims, even though they probably could have fought them legally. He owned 5%, so his voice mattered. He argued that American Express's business depended on trust. Fighting the claims would save money short-term but destroy the brand long-term. Better to pay $32 million in settlements and preserve the reputation. Management agreed. American Express settled. Customers saw the company taking responsibility. Trust was maintained. The stock began recovering. By 1967, Buffett sold most of his position. He had bought at roughly 94 cents per share equivalent and sold around $5, more than 5 times return in 3 years. But he kept some shares. Those remaining shares in Berkshire Hathaway's portfolio eventually grew to be worth over $1 billion, as American Express became one of the world's dominant financial brands. A $13 million crisis investment became a $1 billion position. That's the power of buying quality companies at panic prices. If this video revealed Warren Buffett's crisis investing playbook, leave a comment below telling us where you're from and what crisis opportunities you see today. Share this with anyone who thinks buying during panic is impossible, and hit subscribe so you see the next billionaire strategy before the next crisis hits, because the pattern repeats every decade and those who understand it get generationally wealthy.